Why aren't my returns as big as they should be? Oh, that could have been bad. What's up, everyone? Brian here from Ride Your Money Wave. I just got another email from a viewer just like yourself asking me questions about how can he make better decisions with his investing so that he can make more money. Now, the good news is that he is investing and he's at a young age. But when the conditions change and when some of the options and opportunities change for you to invest, then perhaps the path that you're on isn't the best path. And that's what happened to this young man. So I want to share this email with you. Let's dive in. Let's see what's changed. Maybe the same thing happened to you and we can put you on a better path. He says, last time we communicated was the summer following my graduation, in which I reached out to tell you that I opened up my Roth IRA. First of all, congratulations. You're 17, well, in this case, he's 18 years old because he opened up with Roth. You are 18 years old and you are already planning your retirement. That automatically puts you in the top, probably 5% of people. The fact that it's on your radar screen means that you are going to care about it. You're more likely to care about it, and you're going to pay attention to it. You're going to be more keen to conversations, headlines, you name it. You're probably going to be putting more of your money into your retirement because the sheer fact is you've now created that opportunity for you to invest, for you to follow one of our rules of money that only you can say no to yourself. And rule number 4 of money, that you want your money to work for you, not you for your money. So I encourage everyone over the age of 18 to open up a Roth IRA, because what it will do is it will put it on your radar screen and you'll be more cognizant, more aware of your purchases and your economic decisions, knowing that there's that option for you to save for a tax-free retirement. So congratulations, Justin. I am still proud of you today for opening up that Roth. He said, you'd be happy to know that I put $2,000 worth of my graduation party money in there right away. And that is a big chunk of change for an 18-year-old. So I'm sure that he had to take a deep breath and really kind of get ready for this financial commitment. I haven't had much of an opportunity to contribute to it since due to college, but the good news is that my parents and I have kept me out of debt, which has been my priority all this time. That is another great statement to kind of look at. If you can't win, at least don't lose, right? If you can't be contributing to your retirement, at least don't go backwards and start falling into debt, credit card debt. It's so tempting that when you're driving, maybe from work to, your college class, to stop and get a $7 Taco Bell meal. Things like that are very slowly creep up on you and can wreak havoc on your finances. So the fact that even though you haven't been contributing, you put that $2,000 in it, you care about it, it's on your mind, you're emailing me, you haven't been able to add to it, but you still haven't gone into debt, that's good. That means that you are still right at the start line, if not a little bit ahead, because you put that $2,000 in. Fast forward to today, and you helped inspire me to pursue a degree in finance at Central Michigan. That's awesome, man. That really means a lot to me. Enough of the compliments here. My question for you today is whether or not you found your Roth IRA to be slow growth in the beginning. Okay, let's talk about this. And this is worthy of an entire video, to be honest with you. But the answer is yes. All of us experience very slow growth in your Roth IRA in the beginning, especially if you go with the tried and true data-backed index fund approach. And the reason is because it's just sheer numbers. It's pure mathematics. You are doing all of the heavy lifting and the sacrifice in the beginning of your financial journey. You're bearing all of the burden. Let's say you put $2,000 in, which you did, and it grows 10%. You wait all year and it grows 10%. Congrats, you have $200 extra, $2,200 sitting in your account now. That $200, that might be one paycheck that you can contribute. That might be, 1 month's worth of your savings specifically for your Roth. So if you think about that, it's so much easier to save that money than it is to wait an entire year to only see it move just a little bit. But what happens when you have $200,000 and now it grows 10%? Okay? When that happens, you just made $20,000. That is more than 3 years worth of Roth IRA contributions to the maximum that you can contribute. And you did it in just 1 year. So think about that. 3 years worth of sacrifice, 3 years worth of dedication, and your account did it in just one, and you never had to lift a finger. So in the very beginning of your financial journey, you have to do all the sacrifice. You have to do all the heavy lifting. You have to do all the contributions to your retirement accounts, because what you're doing is you're really just trying to start the momentum. You're trying to start the momentum of compound interest. Now, the more money you contribute, the bigger that compound interest is going to be at the end. But ultimately, what is the easiest way to contribute to that compound interest is by starting young. Because what you're doing is you're giving yourself a much longer runway for that compound interest to work. Justin, the fact that you opened up a Roth IRA and contributed $2,000 at the age of 18, let me tell you, you are at the very earliest start line that you can. Your future self will be quite proud. And I imagine one day, if life treats you right, you'll be telling your kids and your grandkids about your good financial decisions. Your question, whether or not you found your Roth IRA to be slow growing in the beginning, yes. It took me years. It took me from the age of 15 when I first bought my first stock to the age of 30 to have $100,000 saved in my investable assets. 15 years of caring, of contributing, of reading articles, of skimping and saving and sacrificing and making my own lunches and riding my bike so I could save gas money. I mean, I did some ridiculously frugal things in order to hit that goal. And you know what? I can't even tell you when I hit the next 100,000. It doesn't even register. I can't even tell you when. Or the 100,000 after that, or where I'm at today. I mean, what happens is that the market really just starts to take over, especially when you have some killer years like we've had recently where the market goes up 20%, 30%. I mean, 2019, I think the market ended up like 29%. Once you have more money in there, you will definitely see the effects of that compound interest. But in the beginning, it is slow growing, which is why we want to focus less on the decision making and more on our education and our habits, because we can't lose out on the passion. We have to constantly be reinforcing our understanding of the way that this system of wealth works. And so we do that by listening to these podcasts, by watching these videos, by reading books, by building our network and asking questions to people that are curious about money as well. You have to reinforce the passion of your financial journey, because your Roth IRA is not going to be doing it $200 a year at a time. As I've said, I've had my Roth IRA with Wealthfront since the summer of 2017, and I've only earned a total return of about 6.4%, even having a risk factor of 9 since the beginning. even before the market fell this year, I wasn't that much higher. I'd say maybe 8% total return at its peak. Okay, so Justin, here's the thing. Times have changed. When I recommended to you and to the class that Wealthfront was a great place to invest, at the time, that was, I would argue, the greatest place to invest. And here's why. Is because they were very, very generous to students, college students, and I think anyone under the age of, I want to say 25 years old. I don't remember the specifics, but they waived a bunch of management fees and they actually reduced their minimum contribution so that you would open up an account with them. And so if I recall, it was the first $5,000 had zero management fee. And if you were a college student, it was the first like $10,000. So think about that. At the time, you could contribute $2,000 just like you did. You could go all throughout college and even afterwards, and it was the first $10,000 of your contributions would be managed for free. That was the only place where you could do this. And it was either $0 or maybe $500 minimum contribution. At the time, other companies like Fidelity and Vanguard had much higher buy-ins for their Roth IRAs. The average minimum contribution to open an account was about $2,500 for Vanguard. It was $2,500 for Vanguard, and kind of about across the industry. And that's a ton of money for high school students. That's a ton of money even for some adults. And so that becomes a barrier of entry. And we wanted to rid ourselves of that barrier because what we wanted to do is put saving and investing on your radar screen to make it a thought so that it could develop into a habit. And so at the time, Wealthfront was really one of the best places that you could invest because they had a zero, if not incredibly low minimum contribution, and you can invest all the way through college and not pay a single management fee. And it was spread out over 11 different sectors. And the person who sits on the board, this is really important. The person who sits on the board is Burton Machiel. This guy wrote A Random Walk Down Wall Street. That book changed my life. I read it when I was in grad school. Professor Thornton at Eastern Michigan University made us read it. And I remember just diving into that book and falling in love with the data, the statistics, the rebuttals of different trading theories. It is a fascinating book if you have time to tackle another 400 pages of reading. Burton Machiel sits on the board of Wealthfront, and he is an incredibly respected economist. However, since you open this up, things have changed. Now we see that Fidelity offers Roth IRAs with a zero minimum contribution, and they also offer zero fee index funds. I hate to tell this to you, we're still going to help, but that is a better way to invest than your current Wealthfront account. So I ran some numbers. I ran two different sets of numbers. First, I looked at just a I looked at just a S&P 500 from July of 2017 to today. And then I also looked at a Vanguard target date fund from July 2017 to today. And as it turns out, both of them have returned more as a term of percent than your Wealthfront has. Now, your Wealthfront has more diversification. It has different types of bonds. It invests in real estate. It invests in overseas. It has TIPS, Treasury inflation protected securities, whereas the S&P is just the top 500 largest companies. Some of them are exposed to real estate. Some of them are exposed to international sectors, of course, but it's not as diversified. So please understand that you also took on less risk by investing through Wealthfront in their larger, broader, diversified portfolio. However, you're so young. What are you, 20, 21 years old? If you graduated in 2017 from high school, you're so young that you can take a large level of risk. And I'm not saying go put all your money into an individual stock, but I'm saying you can hold a diversified portfolio of just equities. And so if that's the case, maybe you want to look at Fidelity's total stock market fund, or maybe you want to look at Vanguard's total stock market fund, which is recommended by J.L. Collins in his book, A Simple Path to Wealth. He basically says just hold that fund until you are getting closer to retirement and then start sprinkling in total bonds. So if we take a look at the Vanguard Total Stock Market Fund, dating back from July of 2017, it was closing at $30.80. June 1st of 2020, it closed at $35.57. So that difference alone is 15.7% gain. And it looks like you've been gaining, you said, a total of 6.4%. So you're behind what could be just by simply investing in a target date fund from Vanguard. If we do the same thing with our S&P 500, we see that the S&P 500 in July of 2017 closed at 2,454. Today, it's trading just above 3,000, 3,069. So 3,069 minus 2,454 divided by 2,454, which is our starting point. The S&P, since you have invested, is up nearly 25%. On top of that, you can buy these things with even lower management fees than are offered to you through Wealthfront. So, Justin, in short, congratulate yourself. You have made good financial and economic decisions by starting to invest. Okay? I think you are beating a lot of people your age, and I'm proud of you for doing that. However, I think now, because the market has changed, there are better opportunities for you to invest and for you to really put rule number 4 to work. That is, you want your money to work for you, not you for your money. By investing in or through a Fidelity account in their zero cost index funds, or by investing in a Vanguard target date fund, you will have a lower management fee than Wealthfront, which means that more money is going to go to work for you. Another aspect of Wealthfront that I'm not a huge fan of is if you take a look at their savings account, it only offers 0.35%, when Ally offers, I think, 1.25%. So you are getting a 0.9% gain just for parking your money there. So, Justin and all the viewers that are maybe in the same boat who've used robo-advisors, take a look. There are other opportunities. If you haven't, checked in on your money, maybe you opened up a Roth IRA years and years ago and you've been throwing $50, $100 a month in at a time, but haven't actually looked at where that money is going and how it's been performing. Since then, there's been a race to the bottom, and I say that in a good way. A race to the bottom in terms of lowering fees and lowering account minimums. So, guys, hopefully that helps. If you have any other questions, please do 2 things. 1, email me at the email below. And before you go, please hit that like button and subscribe. Tell your friends about this. We are here to build an online community of like-minded individuals who care about their money and are also seeking to help others in growing their financial understanding and their financial wealth. Why? So they can go out and go live their best life. Till next time, take care, everyone.